We've seen so much volatility in the markets in recent days, a lot of it driven by the price of oil. Oil's up 5% even after a historic release by the IEA, and we're certainly in a headline-driven market. How do you navigate all this?
It's interesting because I think there's two different perspectives on this. If you are in the wealth management industry, you're looking at the environment right now, you're asking yourself, do you believe fundamentally we're at some form of an inflection point that warrants going in and adjusting portfolios? And I think the answer to that is no, based on the evidence. I don't think this is an inflection point. I think this is more of cyclical volatility, more of a cyclical correction. If you are paid on your revenue production, if you are a hedge fund, which Steve knows that world well, if you're institutional, you're focused on alpha generation, this has become a horrible environment to do that. And less is more. And you are participating less. The extreme volatility driven by whether it's a tweet or a headline, that's a very punitive environment to be in. So the people in that world that I speak to, they are providing less liquidity. They are stepping back. They are awaiting some degree of certainty involving the oil market. And then we do have two other headwinds in front of us, one of which is software. We'll talk a little, obviously, about Oracle in a little bit. But the other is the financial sector. And let's remember, the financial sector right now is down most of the 11 major S&P sectors year to date. It's having another awful day once again today. And I think that is also a very significant drag on the major indexes.
Weiss, I mean, he just talked about you and your other peers in the hedge fund community. Is that how you see things? You just want to pump the brakes a little bit right now, hold off on making any moves until the volatility dies down?
Yeah, look, return is defined by your point of entry. And right now, we don't know if the point of entry is the right point of entry. Now, if you take a very long-term view and you say, you know what, so-and-so stock has gotten cheap enough for me, I'm going in, and if it falls another 10%, who cares, right? You're taking a long-term view. But look, markets are hard to predict normally, and predicting all the crosswinds, tailwinds and headwinds, how they're going to fall into place, and if they come into existence, is virtually impossible now. So for me, it's pretty much, staying where I am, and I've got a quality portfolio, staying there. If something gets ridiculously inexpensive, like a Netflix or Microsoft, I've added recently, or Alibaba, which, apologies to the producers, I added to yesterday, then that's fine, because I know what the long-term story is for them, regardless of market and volatility in the market. So my advice is, don't get upset about the volatility. Don't try to trade this volatility, because that's really a sucker's bet here. The best people I know aren't willing to trade it, and I think just hold what you have. Don't panic out. That's always the worst thing to do. And we'll just see how it turns out. Nobody knows. What the critical impact's going to be, in my view, is not only how long oil stays elevated, and I'm not surprised to your point that it's not responding to, to the massive, release of the reserves, because that's been well advertised. If they didn't release it, then you've seen something else in the market. But we're also going to hear more job cuts, substantial job cuts from AI, and to me, that's a short-term positive, but a interim, medium-term negative. So I would stay away from consumer discretionary stocks.
All right. You mentioned two interesting points. Number one, the uncertainty, and also the entry point. Shannon, I want to come over to you. Bank of America actually out with a note about this earlier today, saying in part, policy uncertainty is the highest since 2025 Liberation Day. We all remember that about a year ago. And history shows that extreme uncertainty has often marked good entry points for long-term investors. Now, everybody in this market is not a long-term investor. What do you think about this volatility near term? And if you are a long-term investor, where do you put money at right now with the thoughts that things are going to rebound and settle down?
Well, we are certainly long-term investors, and so I think one of the challenges here is balancing out, to your point, what our views were coming into this year in terms of what we felt would outperform and what was kind of relatively well situated, with the acknowledgement that we expected there to be some additional volatility, particularly on the policy side. So if you're in an environment where you expect there to be dispersion, our view was that the underlying economic momentum and the fundamental aspects of things like the transmission of the OBBBA, kind of tax relief coming through, lower interest rates, improved sentiment, and potentially an uptick in M&A activity, all of that pointed us towards what we felt was a basket of quality stocks, not just here in the United States, not just large cap, small and mid cap stocks. Ex-US developed, emerging markets who, frankly, for many of those economies have hit the inflation challenge head on and have a really nice balance sheet and current accounts. So our view is that in this environment, all of those things can continue to be allocated to in alignment with your allocation that you started the year with. I think tactically, you're also starting to see signs that there may have been some overselling in some of the areas that, perhaps we were not as constructive on coming into this year. So technology, for instance, you've seen a meaningful re-rating. But most importantly, I think the dispersion, the divergence, the differentiation between names that we anticipated this year has really come to the fore. On the fixed income side, Frank, we don't talk a lot about that here. But there's actually some opportunities in duration right now. I think we're all focused on credit and credit quality. You look at what's happening in the high-grade bond market, the issuance this week. You're looking at the potential for further curve steepening, especially if we move past the Middle East conflict. So I think kind of reiterating where you stood at the beginning of the year, looking at the underpinning of that thesis, and then taking these opportunities as they're being presented to you is critical if you're looking past the next 6, 8, 12 weeks.
All right. Jason, we'll come over to you. Joe mentioned the wealth management business. That's the business that you're in as well. What are you telling clients right now? I'm sure some people want to take some chips off the table, I would imagine, because some parts of their portfolio have been under pressure. Where are you seeing the opportunities? Where are you seeing areas that you think might be seeing long-term damage?
Yeah, no, I think it's a little bit of the play that's already been moving so far this year, which is obviously the infrastructure, AI beneficiary stories, the Eatons, the GE Venovas, the Cornings of the world. I think those stories still remain intact. I think the other opportunity is, to Shannon's point, what's going on with tech. The hyperscalers obviously haven't meaningfully participated so far this year, and I think you always, in geopolitical events like we've experienced, there will always be dislocations, and you always got to do a pulse check on where we are in the cycle. So I do think the hyperscalers are an opportunity. That's another place where we're looking at. And I think software now trading at 16 times forward, which is below a market multiple. I think there will be opportunities there as well, because I think there's a harmonious play with AI and software on demand. We'll see how this story continues to play out, but I think those are a few of the areas where there's opportunity.
Yeah, a number of recent notes saying this is an attractive entry point for software, one of those areas that a lot of people seem to be putting some money in. I think we have to go back to oil. I'm looking at oil right now, up about 4.5%, almost 5% right now. And I said this on Closing Bell the other day. We keep having people come on, whether reporters or traders like yourself, saying ever. Biggest release from the strategic reserve ever or since. WTI had one of the biggest price moves yesterday since 2022. Joe, you made some moves in the oil space. How do you play oil here, or should you even try with so much questions going on about the Middle East? And I just want to point this out in my world. Maersk reporting an issue in Oman just a short time ago, about an hour ago, saying that they're shutting down operations there. So we continue to see issues outside just the oil market with this conflict.
So you had to, I think, get in front of it in terms of energy allocations. In the fourth quarter, it was very clear, to Jason's point, the market was making a shift away from high beta, a shift away from momentum towards quality, towards defensive. Healthcare, leading sector. Energy began to make its move in the fourth quarter. So in front of that, refiners were clearly some of the energy names that you wanted to own. I own Valero, I own Phillips 66, I own Marathon. Till this day, I still own Valero. I think you maintain exposure there. In addition to that, I have EQT. So I think you had to be kind of in front of it. If you're now in the moment and you're trying to race to catch it, you're not going to. Right. Because it's the equivalent of the Rocky movie where he's chasing the chicken trying to catch it. You're just not going to catch it. And if you think about what's gone on here with the actual spot oil market, I gave some statistics the other day. I said at the end of February, the average volume for spot crude oil was somewhere around 300,000 contracts per day. We had bumped that up to 1 million once we had the conflict that began with Iran. Now what we're seeing is that figure's coming down once again. And what that's telling me is that professional oil traders are doing exactly what I'm suggesting, what I'm advocating for. They're stepping back and they're saying, wait a second. These headlines, they're just dizzying. The tweets, they're dizzying. I can't get in front of, I can't profit from a headline or from a tweet. And I think a lot of people are basically stepping back. So I don't think you're chasing it here. I think if you were fortunate enough to have the energy exposure coming into it, you maintain it. But certainly I think at this point, oil could go up or down 10 or 15% on the next headline or tweet.